Good morning, everybody, and welcome to Coffee with Counterpoint. This is our first Coffee with Counterpoint of the year, and it feels like the year is already 8 months old, but we're only 2 months in. Joining me today, I've got Ian Anderson, who's a portfolio manager in our Payers and Growers franchise, Raymond Shapiro, who's a portfolio manager in our Quality franchise, and Paul Trelevis, who is an equity analyst covering SA and global stocks. My name is Brian Pyle, and I'm the CIO at Counterpoint Asset Management. Counterpoint Asset Management is a multi-style boutique offering our clients a fund selection across SA and global capabilities. And if you ever need to contact us, please contact us on info@cpam.co.za. If you ever need any more information, we'll gladly help you. Just some housekeeping before we get going and get into the nitty-gritty. We use GoToWebinar for these events, and for your best possible experience, please close all your other applications, particularly if your sound goes. The sound is the first thing that tends to go, and if that happens, please close your other applications and it may sort itself out. There will be CPD points available for this webinar. How it works is we apply for the CPD points to be registered. That takes about 2 to 3 weeks, at which stage you will automatically receive your certificate by email. There will be a survey at the end of the webinar, and that survey helps us to service you better. So we ask you to please fill that in. It shouldn't take longer than a minute or two, and that'll pop up automatically at the end of the survey. There's a Q&A box in the navigation page, and if you would like to pop in a question there, we'll pick that up and try and answer that as we go along. And if we don't get to that, we'll try and email you a response as soon as possible. So thinking of today, many of you will think, well, why are we not talking about Russia and Ukraine as the main topic? I think for us to add to the noise that's out there, given how many unknowns are there, it would be silly of us to just add to that noise. So we will reference Ukraine and Russia in terms of our exposure to that, which right up front is very low. But of course, the things that we are thinking about is the second and third and fourth round effects of that war, and how that affects the positions in our fund. So our direct exposure is negligible, but we continue to think about how that will affect us going forward. The other big topic that's still around is inflation. And how that's going to play out. It's looking to be that it's more sticky than most people would have thought, certainly this time last year. We did a Coffee with Counterpoint on that topic in November last year, and our views haven't changed much since then. So if you'd like to get a copy of that, it is available in Insights on our website, and you could use the info@cpam.co.za email as well if you're battling to find it. Okay, so to get going today, we look at our funds through different lenses, and we're going to just share with you some of the lenses through which we look at our funds, just to understand what drives the performance of our fund. To kick off, we're going to just run a poll, and if we can run that poll and just kick us off, and then we'll go into the information in the detail. So using the all-share index, i.e. the company weightings, what percentage of turnover, company turnover, do you think is derived from South Africa as opposed to another jurisdiction? So if you could just populate your thoughts on the answer there. Right, we will keep the poll going for another 10 seconds or so. We've got a good response already. We'll give it another 5 seconds. There are still a few coming in. We're up at 60% of people have voted. Another second or two, Jaco, and that's it. We can close the poll. Okay, so there are the answers that you supplied. 37% saying that turnover from South Africa is between 15 and 30%. 31% to 45%, 46%, 46 to 60, 14, 61 to 75, 2. And the answer is actually 25%. So for the detail on that, we've got a few slides which Paul Trelevis is going to take you through now. Paul, over to you. Thanks very much, guys.
Thanks, Brian. So I'm just briefly going to chat to these three main topics. The first being the JSE geographic revenue exposures. So where do our JSE companies earn their revenues from? A bit on China and resources, and then a bit on SA Inc. and our Rand hedge stocks. So the first, well, the results of this. So we basically, for every listed company on the JSE, we sourced where they got their revenue from, and this was the result. You can see, I don't know, surprisingly or unsurprisingly, about a third comes from China. And as you just mentioned now in our poll, only 25% comes from SA, 13% from developed Europe, North America, APAC, etc. And that massive chunk coming from China can be attributed mostly to these three buckets. So resources being the lion's share, Naspers and Process about 20% of that bucket, and Richemont about 20%. So Naspers and Process, interestingly, about well, over the last year, they're actually down 50%. So not so long ago, that would have made up almost half of this China exposure. And Richemont currently makes up about 11.5% of the JSE. And we've found that about 64% of Richemont's revenue is actually from China nationals. So mostly driven from China, Richemont's revenue. And because it's quite topical, we've also scraped out what kind of exposure, revenue exposures are actually exposed to Russia. And we found the biggest exposures were Barloworld's. They have about 25% revenue exposure to Russia. Mondi will have about 11.5% exposure to Russia. And then Sappi under 4%, and Richemont a little bit, and a few other bips and bobs. But overall, our JSE revenue exposed to China is only about 1.5%. So not large revenue exposures to Russia. Quickly on China demand, just to kind of show you the magnitude of China's influence on the JSE and our resource stocks. This is global demand. So China consumes over 60% of the world's iron ore and over 50% of the world's aluminium, magnesium, nickel, copper, zinc, roughly a third of the world's PGMs, and a large chunk of the coal, oil, and diamonds across the world. So that's just massive. Here again, we can see the China consumption across the world. And just on to illustrate it on a stock level, you can see BHP generates roughly 64% of their earnings from iron ore, 15% from copper, and from coal, etc. And that, if you times it all out, works out to about 50% of their earnings coming from China alone. And you can do this across the rest of our kind of resource stocks listed on the JSE. And overall, we found about 44% of all of our JSE resource stocks derive their revenues from China. So China is a massive driver of SA resource stocks, and in SA indirectly, I suppose. Just to show you now quickly of basically SA paired up against other countries and regions. You can see this is on where they earn their revenue locally versus offshore and China. You can see the USA being mostly a consumption-driven economy. They generate 71% of their revenues on their local shores and about 29% offshore. Europe is a more open economy, about 50% they earn onshore. Japan, China, surprisingly, being a large exporter, actually their listed companies earn 86% of their revenues in China still. And then EMs, excluding China, also quite open, but 53% still earned on their local shores. South Africa, in comparison, only earns, as we said again, only 25% of its revenue locally and 75% offshore. And of that, 33%, as we said, comes from China. So just highlights kind of, I think, the fact that, South Africa is a very small and open economy and very kind of exposed and dependent on kind of foreign demand and flows. Okay, this is another cool kind of lens we like to look through at the JSE at. This is market weights, it's not revenue anymore, but So we break it down by SA Inc., which is your local kind of stocks, AVI, your banks, Mr. Price, Transaction Capital, etc. You have your Rand hedges, your AB InBevs, Richemont, BATS, Mondi, etc. And the resources, gold, and Naspers in process. Naspers in process, surprisingly, under 7.5% now only. As I said, you know, the share price is down almost 50% over the last year. Okay, so this is a breakout of that. So comparing SA Inc. stocks that stayed in SA versus SA Inc. stocks that ventured offshore. So the SA guys that decided to stay local, focus on their local operations, they didn't have FOMO, they stayed here. You can see how they kind of performed versus the guys that went offshore and obviously destroyed a lot of money. And it kind of came through, and we saw it in the financials, and we can see it here in the share price performance. So those are the guys that went offshore, just a few of them, you know, Woolies, Mediclinic, Netcare, famous brands on Mutual, Shoprite, and a lot of them actually subsequently have returned and are more actually SA Inc. stocks now because, yeah, the offshore forays essentially didn't pan out well. But we can see, my point is SA Inc. actually didn't do too badly over a 10-year period, about a 12% CAGR. The guys that ventured offshore, as we can see, they didn't do as well. And then just to overlay this, we can look at the Rand hedges. Also not too bad over 10 years. This is in ZAR. But I think interestingly, you can see up to 2015-16 was their kind of peak, and they're actually down still over those from that period. And I think that was obviously due to, you know, euphoria of Anheuser coming in and buying SAB. Richemont and BATS were still doing well. Aspen and Steinhoff were still the darlings of the market. And you can see kind of the peak in 15-16, and they've kind of moved sideways and downwards from there. So that's just some interesting returns of our SA Inc. stocks versus kind of our Rand hedge stocks in the JSE. And just to finish off, I think if there's two things we can take away from my slides is if you're buying a local JSE fund or something that looks similar to the Aussie, you're going to be very exposed to resources, Naspers and Richemont, and in other words, China. And the other portion, which is obviously a lot smaller and kind of unloved or unlooked at, is the SA Inc. portion. And I just want to maybe say how well they actually did through COVID. They managed their operations really well. They held back on capex and they managed the inventory really well. All of them generated solid free cash flows. They improved their cost efficiencies, and they actually withheld a lot of their dividends. But we see those dividends coming back now, and yeah, we don't think that they'll be venturing offshore in a large way going forward. And yeah, hopefully, you know, from the years of the Zupta years, we're on a different kind of path now. I know it's a bit slow, but hopefully the ship has turned and we're heading in a better direction. That's all for me, Brian. I think Ray is up next. So Ray,
we're going to hand over to Ray and ask him to take us through how that fits into his thinking and his fund management work. Thanks, Ray.
Thank you, Paul. I will say just up front that separating out the geographic exposures of close to 200 companies in the JSE All Share Index is a painstaking exercise. It's not really something that you pick up on the cover of any fact sheet or you will likely see in many places. You have to pull from many sources. It's not simply a matter of opening up the financials and seeing it there. You have to use a fair amount of mosaic theory, but we are very confident that we've got it pretty accurately, and I just want to underscore the importance of looking at a portfolio in that fashion in terms of both the geographic exposures, because that tells you about currency risk, it tells you about sovereign risk, it tells you about growth prospects, and it tells you a lot about diversification as well. And then the other grouping in terms of SA Inc., Rand hedges, resources, Naspers, and of course a direct offshore weighting, because as we know that a lot of SA equity funds now have a direct equity offshore allocation. Those things are very important in terms of how you make decisions in terms of allocating funds and managing people's money, because you could be taking on currency risk and sovereign risk that you really don't intend to. So just to talk, I'm going to spend a fair amount of time just talking to this slide. On the left-hand side, we have the see-through revenue exposures. For now, we're going to keep our discussions to local equity and property funds. In future, we will look at global funds. But needless, I will just say there's no reason to panic about Russia or Ukraine in any, in our global funds. But for today's session, it's just local equity funds. So the see-through revenue exposures of the Counterpoint Dividend Equity Fund, as we can see, it's got very low exposure to China, and that's just really bits and pieces of different global companies. South Africa, this is quite interesting. You'll notice that on a see-through revenue exposure, it's about 44% exposed to South Africa. Now, on the right-hand side, just to allay any confusion, you'll see our SA Inc. exposure is 57%. The reason for the difference is that even the SA Inc. companies are obtaining about 20% of their revenue from offshore sources. So there are SA Inc. companies, predominantly South Africa, but there is some SA Inc. So we look through all that. Additionally, the bar charts on the left-hand side do include the fund's 27% direct offshore weighting, which includes companies such as Nestle and Union Pacific, TJ Maxx, Deere, etc. So it's totally see-through, and one can see that the South Africa exposure is still quite significantly higher than the JSE, and then we've got good exposure across developed Europe, APAC, ex-Japan, and it's quite a different exposure to the JSE. Very little China exposure, and very little exposure to various other regions. On the right-hand side, you can see how the fund is broken up. Essentially, we only have we've got about 3.5% in resources, which is an Anglo-American. You'll notice that's quite different to the all-share index, which is over 40% resources. Instead of those, we have our holdings in direct offshore equity, so it's highly differentiated from the all-share index. I think we can move on from this slide. So just going back to, this is simply the earlier slide, just to remind us of how much demand comes from China. A huge portion of iron ore, and as we know, iron ore is a major money spinner for our big stocks such as Billiton and Anglo-American. Additionally, copper is a significant money spinner, as are PGMs. For our local stocks, and if you peruse across there, you'll see 64% of BHP's EBITDA is driven by iron ore. Anglo's is around 37%. Glencore does not have exposure there, but has significant exposure to copper. So China is is kind of the elephant in the small room when it comes to these resource demand that drives JSE listed stocks. Just moving on to the next slide, I'm just going to paint a picture of resources quickly. Now, predicting resource prices is a highly risky endeavor, and now we can see that resource stocks, platinum stocks, and gold stocks, of course, have been very strong recently. But I think it's very important to step back from kind of short-term trends. We don't know how long this conflict is going to last. And additionally, we don't know how long supply bottlenecks are going to last. But if one steps back, the major driver of resource demand in the world is China, as we illustrated. And as you can see from the chart on the left, it's China's real GDP contribution. Now, just focus on the purple bar, and you can see China it was driving 8% of the 9.4% of China's growth in 2009. And we can see how that purple bar is compressing, and it's taking China's growth rate along with it. So China is talking about moving from an investment economy to more consumption-based. The increase in consumption is not making up for the decline in investment. What's more, the consumption matters little because investment is what drives metals prices. So investment is really bearing the brunt. As the China economy slows, investment spending bears the brunt, and therefore metals bear the brunt. And the graph on the right-hand side just shows a fixed asset investment. It's on a long-term downtrend, and I would be shocked to see it suddenly revert back to normal levels. In the short term, maybe an election year it could, but the long-term trend is down. China has built massively over the last few years. Just moving on to the next slide. This is just about Chinese industrial production. So it's more or less investment focused and just factories going and consuming things, more probably on the aluminium side. And retail sales, same story. There's a downward trend as China moves from the kind of the high single-digit growth to the mid to low single-digit growth, which they have well communicated and are in fact comfortable with themselves. To grow 4-5% for the Chinese economy is still a massive number, but it's not nearly as big as it was. And then we can see the production and consumption is slowing as the debt is climbing. China's debt to GDP ratios, for governments and non-financial corporates as well, and a lot of those are SOEs, is just climbing and climbing. So you can't have, what's more important, in fact, than the static debt to GDP ratio is the rate of increase, and risks are increasing there, and the Chinese authorities and government have flagged those risks, so they're well aware of them. So moving on to the next slide. I would say if you're going to look at one graph or one indicator to try and predict metals prices, including iron ore, copper, aluminium, and the rest, and platinum, it would be the China credit impulse, which really is an indicator of how much of GDP is being driven by credit. It's a ratio. And you'll see what we do is we brought forward the credit impulse because obviously it's a leading indicator. So we've kind of brought it forward to overlay it, and we can see what a tight fit that is with the industrial metals index. That's a Bloomberg Industrials Metals Index. We can see how closely it tracks it. Except now, so metals prices have shot up and totally disconnected from the China credit impulse. Now we can see the credit impulse is ticking up, but the metals prices have already, in my personal opinion, they look like they're in high risk of overshooting. So perhaps the credit impulse goes up a bit, but as we know, debt is already high. So there's significant risk there in metals prices. What I put on the right-hand side is this global PMI suppliers delivery times index. The higher that graph is, the higher the line is, the longer stuff is taking, the greater the bottleneck. So it looks like a lot of metals price strength, and therefore resource company strength, is being driven by continuing supply bottlenecks, which when those clear, there's significant downside risk to metals prices. I don't know where metals prices are going. I'm just saying there's significant risk, and understand the risk one takes if you've got 1/3 of your portfolio exposed to China or 40% in resources. There are risks involved. And thank you very much, Brian. I think we can move on to the next slide. This is just some earnings forecasts, and as we know, this is the sell side. They don't have a perfect record of being accurate, but this is just what the market's thinking. We can see over the next 3 years, SA Inc. stocks, and this is in rands, are forecast to grow some 46% earnings, and that is because the base is quite low. But also because companies have become a lot more judicious in the allocation of capital, less wasteful, not wasting money offshore anymore. The MSCI world is also looking for a bit of a bounce back. The all-share less so, and that is due to resources. Forecasts are for resource company earnings to come down, so we're at a peak in earnings. That's what the market is saying. It doesn't mean that that's right, doesn't mean they can't go higher, but the market is saying that resource prices and therefore earnings is going to come down in future. And thank you very much, Brian. I think we can move on to the next section.
Thank you, Ray. Thank you, Paul. We're now going to hand over to Ian to take us through some of the thoughts on how this might play into property exposure. Thank you, Ian. Over to you.
Thanks very much, Brian. And yeah, I don't think I don't think this is going to come as a major surprise to many. But obviously, the South African listed property index over the last decade has become anything but South African. If you look at where growth has come from, and when I'm talking about growth, I'm talking about the sort of expansion of portfolios. Most of it over the last 12 or 13 years has happened outside of South Africa, with the bulk of that in Central and Eastern Europe. You know, if you sort of go, and this is a bit of a history lesson now, if we go back to 2008, 2009, 100% of the South African property market was invested in South Africa. There was very little appetite to go offshore. The yields were much lower. Borrowing costs were not substantially different to the yields that you were getting on properties. But something changed, and that change was the GFC. Following or after the GFC, property yields were slightly higher globally, but more importantly, the cost of capital was substantially lower. And you suddenly had this huge gap between the cost that you would pay for your debt versus the income that you could generate on buying a property. And so South African investors who've done something similar in the late 90s, early 2000s, when borrowing costs started to fall in South Africa, but property yields stayed high, and you had this sort of yield gap emerge, and that obviously done very well as a result of that. They decided to replicate that same model in international markets, and the market that offered them the best potential was Eastern Europe, particularly markets like Romania and Poland. And so South African investors threw themselves at these markets quite literally. I can remember a Jones Lang LaSalle director in Poland mentioning to me that the most disruptive influence on the Polish market over the last decade had been the emergence of South African investors in that market who were prepared to pay as much as 20% more than locals for those same properties. And the reason why they were able to do that was because they were funding those transactions 100% with debt, and that debt was costing them almost nothing. They weren't borrowing that money in country, so they weren't having to subject themselves to a credit review in country. What they were doing was they were converting their South African debt using cross-currency swaps into foreign debt, and obviously benefiting from very good credit ratings here in South Africa. The banks had significant collateral over the properties. The yields that these companies were able to, or the interest rates that these companies were able to get was substantially lower, certainly than what they would have been able to get in country, and that allowed them to outbid the foreigners, or the locals, should I say, in those markets, the South Africans being the foreigners. And so we saw this massive increase in exposure to non-South African markets. And as I mentioned, a significant chunk of that was into Central and Eastern Europe, which introduced a whole host of new risks to investing in South African listed property, and I think highlighted right now by the fact that it is a region that is sort of constantly in a state of flux. There's always a lot going on politically, and it's obviously culminated in a conflict between Russia and the Ukraine, which is now almost certainly likely to spill over into other Eastern European countries as migrants start to move into countries like Poland and Romania, both of which border Ukraine. In fact, 75% of NEPI's rental income comes from countries that actually border Ukraine. But the biggest risk is still this huge mismatch between the fact that borrowing costs are at historically low levels versus the yields that you can get from property. And the bulk of the properties that these companies actually bought were retail, large regional and super regional shopping centers, which in itself is presenting a longer term risk, again, as companies, big, large online retailing businesses like Amazon start to enter these markets. It also changed the way that investors thought about listed property. Prior to 2010, people thought about listed property in terms of the income and the growth in that income it could produce. It was a cornerstone of most retirement plans, pension funds in the late 90s. had as much as 25% of their portfolios. These are defined benefit pension funds at about 25% of their portfolios in property because it was a good source of regular growing cash flows. But this massive move into non-South African markets meant that the income being generated by a lot of these companies actually declined in absolute terms. So yields in the sector went from around 10% to as low as 4.5% at one stage. I think in 2014 or 15 or 2017, the overall yield on the sector was around 5%, similar to what you'd get from the equity market. And people started to think about listed property more as an equity than as a bond or with bond-like characteristics. Clearly, things have changed, and people have gone back to thinking about this as an income play and an income growth story. But we've always kept that front of mind. We've avoided this sort of behavior to go chasing these sort of returns, to go chasing these highly geared positions. So if we move to the next slide, you'll see just how differentiated our particular property strategy is relative to the SAPI index. And the first and most obvious difference is the fact that we still have a bias towards South Africa. Almost 80% of the Net Group Investments Property Fund's allocation is to companies with exposure here in South Africa. That means that, yes, we don't necessarily get that supercharged growth you get initially from buying a property with a very low cost of capital or using very low capital with a very low cost to go and buy properties. It does, however, mean that you get higher yields. You get a bit more certainty as well in terms of you're not having to deal with different currencies. And you can see that the other big difference between the Net Group Fund and the SAPI index is obviously the allocation to Central and Eastern Europe, where we think they're, not just because of what's happening today in Ukraine, but where we think longer term, the prognosis for the investments in those particular regions is not good, given the fact that the bulk of that exposure is into regional and super regional shopping centres. And if we move to the next slide, you'll see just how the retail exposure of the SA listed property index is made up in terms of the various property types. So we're not, when you think about, your exposure from a property perspective, it's not just about the geographic exposure, because there are fundamental differences between the way that various property types move depending on the cycle, the way that they move relative to each other. And I think the two property types today that are talked about the most is retail and office. And should I say, from a negative perspective, obviously people are talking about logistics and warehousing, but that's obviously with a very strong and positive momentum behind it. But the two property types that appear most at risk, given some of the structural and behavioral changes that we've seen over the last 4 or 5 years that were then accelerated by the pandemic, definitely office and property, and retail. And the retail that most people are concerned about is the regional and super regional malls. So the properties with sort of gross lettable areas, that's GLA, of sort of 50,000 square meters plus. And you can see that in the South African listed property index, bearing in mind that overall the retail exposure in the SAPI index is around 57%. So this is, you're talking about almost 60% of the SA property index made up. 40% of that 60% is in property types that are under threat longer term, and then you slowly move down. You get 36% of your exposure into sort of what we would call large neighborhood or community centers, and then you get the smaller, less than 25,000 square meter GLA, which is your convenience, very much convenience, and it's in that particular space that we want to play. So when we construct our portfolios, we're not just looking at the opportunities that we can invest in or the companies that we can invest in. We're looking through those companies to try and understand what sort of exposure we're going to get, what sort of geographic exposure we're going to get, and then more importantly, what sort of property type exposure. And if you just look, if we move one slide forward, and you look at just how significantly different the Net Group Investments Property Fund is again to the SAPI index in terms of retail exposure. the bulk of our retail exposure, over 55%, is in those community and neighborhood shopping centers, very much convenience oriented. And if you go and talk to any management team in South Africa today, in fact, don't even talk to, you don't even have to talk to the South African management teams, you can go and talk to the global management teams as well. The one thing that they will tell you is that today, one of their top performing property types is convenience and neighborhood retail, and for a long time now, the Net Group Fund has had significantly more exposure to that type of property than we have to the larger shopping centers, which are under threat from online retailing. They're also under threat because they have a significant entertainment element to their centers. And today, a lot of people are entertaining themselves at home. You know, technology has advanced so substantially that you don't have to go to the cinema to get an awesome experience watching a movie. You can actually get that experience at home, and it's a hell of a lot cheaper as well. You know, taking the family to go and see a movie these days is very expensive, whereas today, you know, a lot of those movies come out on streaming services before they even make it into the cinema. So the way that we are entertained is changing as well. And so there's a significant amount of threat to large shopping centers. And so as a result of that, the Net Group Investments Property Fund, and we may have been criticized for this in the past, but it's certainly working very well for us now. We're prepared to take, or we're prepared to construct a portfolio that looks significantly different to the market. And the reason why we want to do that is in order to capture the opportunities that we see, and also to avoid some of the risks that we feel are inherent in a lot of geographies today, and then a lot of property types as well. With that, I'll hand back to Brian. Thanks very much, everybody.
Thank you very much, Ian. Thank you, Ray. Thank you, Paul. We're going to do some Q&A now. So as a reminder, you can post a question to us in the navigation pane, and we'll try and get to that. You know, my key take out there is when you're buying an Aussie fund or a fund that looks very similar to the Aussie, just be aware of your exposure to China. And certainly, you know, we're not saying that that's necessarily going to fall in a heap, but just understand the intended or unintended consequences of what you're buying. That leads me to the first question. I'm going to pose this to Ray and Paul. I don't know who the best is to answer this, but if you could describe and discuss the other lenses that are out there that you think are different and important for, I guess the question is for us as portfolio managers to look at. The actual question is saying as advisors, you know, what are the other lenses that we should be thinking of? But I mean, I guess it's both of us, both advisors and portfolio managers. Some of the non-obvious lenses that you are thinking about and work that might be seen in future Coffee with Counterpoints. Ray and Paul, I'm going to leave it to one of you.
I'll leave it to Ray.
Okay, I'll go first. I mean, I think maybe it's not a non-obvious lens, but of course the different sector breakdowns is quite important, and how the different levels of, or should I say, the patterns of growth and how companies behave. So the obvious level would be cyclical companies versus defensive companies versus companies that are structural growers, or like technology was definitely a structural growth. It was neither defensive nor cyclical. There was structural growth, and as we've seen now, structural growth can sometimes suffer some bumps in the road, or suddenly a plateau, or worse. So I think that's another important distinction of how companies, you know, what their growth profiles are. And then of course there's the emerging versus developed market split. There's the Europe. You know, Europe and the US operate quite different forms of capitalism. The one is far more socialist. So, you know, those kind of things are important. And then even within the sectors, how different sectors react to inflation, there's quite a variation. So for instance, things like technology historically actually haven't done well during periods of inflation, as cyclicals haven't done well, but for instance, healthcare has done a lot better. So a lot of it comes down to as well is different business models is also very important. So different companies, some companies make annuity-based revenue, some it's more contract-based. So those are just some of the lenses that we look at. But at the end of the day, what we want to know is two things. What is the return outlook or the growth outlook, and what are the correlations? So often the reason we slice and dice things up is to risk manage, so we make sure not everything goes wrong at once. So yeah, I think I probably exceeded my time quota there. I don't know, Paul, if you've got anything to add.
Well, just from my perspective, being an equity analyst and actually looking at the companies from a bottom-up perspective, I would look at the earnings, the stability of the earnings, and you as obviously the portfolio manager would piece them all together to construct a portfolio. But I think it does come through in the share prices. If you're constructing a portfolio with more defensive kind of characteristics, more stable earnings, higher free cash flows and dividend yields, etc., you do kind of see it in the share price kind of performances. And just as an example, if you price maybe the banks maybe versus resources, you can really see it in the performances. Banks kind of chugging along steadily, and then the resources going up and down quite volatilely. So yeah, I think the bottom up does come through in the share prices and the actual outcomes of portfolios.
If I may, sorry, Brian, if I may add, there's obviously the COVID, the long term and the short term and long term COVID winners and losers, as well as companies that have significant recovery potential is something that's more topical at this point in time. So who has recovery potential, and maybe where is there a risk of things falling off? So in a lot of online retail businesses, there's a risk that the base is high and it starts to normalize. So that's another lens with which we look at companies during this time.
Thanks, Ray. Yeah, and I'm going to pose the next question to you, because I know this is a debate we've been having internally, but with all the turmoil that's going on in the rest of the world at the moment, and particularly other emerging markets, does this make South Africa look more attractive on a relative basis? And I guess this is a question of, are we the least dirty shirts on the laundry line? Maybe you can answer that, and I know you have been looking at flows lately. If you've got any updates or numbers for us on that, that would be great.
Yeah, Brian, I think that's probably, I think South Africa has clearly been a major beneficiary of the turmoil that we're seeing in the rest of the world. So, if you just think about, Russia, we compete with Russia for an allocation in emerging market funds as well as in global funds. We clearly compete with China, and China is a much bigger player in that space. We compete with the likes of Brazil, and yeah, I think today we are the cleanest dirty shirt, and it's definitely coming through in the flow. So we've had 5 consecutive days of net foreign inflows into our equity market. You probably got to go back probably more than a decade. I don't have the numbers in front of me, and I might be talking complete nonsense, but I can't remember a time where we've seen this sort of persistent level of inflows. And if I do the maths quickly, I think we've had about somewhere between 12 and 16 billion rands worth of net inflows. Certainly the last 3 days, we've seen about 12 billion rands worth of net inflows into our equity market. I think it was 4 billion, 6 billion, and 2 billion over the last three days. And it's, I think in the beginning, it was just to replace the resources exposure that people were now no longer going to be able to get in Russia. So you saw that initial jump up in the prices of the resources sector, but the last 2 days, there's been significant follow through into the broader market. If oil's at $110, I'd be selling for Foschini Group and Mr. Price and the retailers, but nobody was doing that yesterday. Everybody was buying these things. And that's one, because they're very cheap. South Africa has started off as one of the cheapest emerging markets. So it's not that you're having to think too hard about where to put that money. So you're putting it to work in a reasonably okay economy, certainly in the context of the world today. But importantly, you're investing into businesses that are trading at historically low multiples, whether in absolute terms or in relative terms. And I think that is more important right now for a lot of foreign investors than what is the oil price likely to do for inflation in South Africa and for the consumer pocket. So yeah, I definitely think we are a major beneficiary of what's going on in the world right now.
Yeah, and sorry, just for clarity, you mentioned the equity market. Is that following through into the bond market as well, or have you not looked at that?
No, it's definitely not following into the bond market. In fact, we've seen outflows, and I think that's just because there is another market that you go to when you're worried about global inflation, and that's the US. So, I think when you think about, whether you own Russia, you don't think about the United States or UK, you think about other emerging markets, but it's clear in the bond market there is a slightly different story. So we've actually seen outflows from our bond market, which is consistent, with what has happened with the pricing. So this has been very much an equity-driven story, and it's helping the rand. The rand should have weakened substantially given what's happened to the rest of the EM basket, but because of what's happening in terms of flows, the rand has been very strong as well.
Thanks, Ian. So I'm going to take the next question to start with, and then if anybody would like to add, you're more than welcome to. The question goes along the lines of, are you seeing evidence of better capital management in South Africa? And if so, can you give us some demonstration or illustrations of that better capital management? We're in the middle of results season as we speak. We're seeing a lot of companies releasing results, be it interim results or final results to December 2021. So I think a common theme that we're seeing across that is turnover is recovering in the companies that are exposed to SA Inc. I'll use Bidvest as an example, where their turnover was up 13%, but their profit was up, I think it was 25%, and headline earnings per share up 30%. I think the same could be said for some other companies. I've just jotted down Italtile, Cup, and Hudeco as companies where turnover was good, not stellar, but good, but where because of good capital management, good cost control, they've been able to improve their margins. And well, yeah, that's good cost control. And then because of good capital management, that flows into an even higher number down at headline earnings per share. So that's, we're seeing that in results that are coming out. Maybe one of you can comment on the retailers. I can't think of it offhand whether that theme is coming through those, but certainly, the more industrial companies such as Bidvest, Cup, Hudeco, we're seeing that improvement. But then just, I guess it's more anecdotally, when we speak to company management, there's no real talk of, great ambitions to take their business offshore anymore. Definitely not, big plans into Africa where, 10 years ago, with a lot of companies going up and putting down factories and opening shops and things in Africa. We're not seeing a lot of that at the moment. I think a lot of company management are saying, let's do what we do well at home and just make sure we give our shareholders the best output there. And I think we are seeing some of that in the company results that we're seeing at the moment. Ian, I don't know if you can add to that from a property perspective, or if any of you would like to add.
Before Ian jumps in, should we just, sorry Ian, should we stick with equities? Because I think the main one is obviously ShopRite, who wasted a huge amount of money in Africa, and the minute they stopped that bleeding and redirected money towards South Africa, they started doing extraordinarily well. I mean, the company has turned around amazingly. I'm really very surprised by it, and of course they were forerunners in the implementation of SAP, which then allowed them to offer things like Checkers 60. So that is a very clear example. And then other companies such as Mr. Price, which were having little funny forays offshore, they quickly killed that. And then of course Woolies, we know the disastrous David Jones situation, but since new management has come in, they've stopped the bleeding, their ring-fence things, so companies are well aware. And then of course Netcare, which also wasted a huge amount of capital in the UK, has refocused totally back on SA, and we think going forward, there's been a COVID speed bump, but going forward, results are going to be significantly better with focus. And I think in all my experience, the most powerful thing in investing and then in investing in listed companies is the more focused the company is, the better it does. And I think it bears out. But those are just, those are just a few examples. And Ian, I'm sure you can give a few more, both equities and property.
Can I add a little tidbit on Shoprite? Also, obviously, the prior management was heavily incentivized by only EPS and HEPS growth, and obviously they just used the balance sheet and they juiced it up with debt, and they expanded quite aggressively with debt and issuing of shares actually. And then obviously, since they've changed that to a more capital efficiency kind of incentive for management, we saw that in the last 4 or 5 years, and that's definitely also turned the tide for Shoprite there. That's all.
Ian, anything to add?
Yeah, I think on the property side, I'll only just add that, we have started to see a reduction in cross-currency interest rate swaps, so the mechanism that a lot of these businesses use in order to get that offshore exposure very cheap, and then obviously allowed them to overpay. So that is at least a good discipline, but it's been a lot more difficult for the property companies to allocate capital. Their cost of capital is much higher now. Many of them have obviously been very inwardly focused in trying to sort out tenants that were battling during COVID. So I would expect it takes a little bit longer for the property companies to exhibit improved capital management. But we're seeing early signs. The stuff that they could do, they have done, but I think there's still a long way to go. But that only really happens when their cost of capital improves and when they actually have the flexibility to make the changes. Yeah. So, but I think, Paul, just on your point, I do also think though that the way in which management teams are incentivized has a massive impact on how they behave. And just to bring that into the context of the property businesses, that why did they go offshore? Well, because they started to be incentivized not in terms of a total return to shareholders, but in terms of how much they could grow their earnings. And the easiest way to grow their earnings is to go and buy 2 billion rands worth of Polish property on a 5% yield and fund it with debt at 1.5%. You immediately get a huge kicker to your earnings, and you bank a big bonus. And I think we need to acknowledge that a lot of the behavior that we saw in the listed property sector was driven by these incentive packages. And so we've desperately tried to get those things changed. We often vote against a lot of the incentives that the management teams sort of show us, the new incentive packages, because typically they are still driven by an earnings outlook rather than a sort of a property value uplift or a total return focus. But things are changing slowly.
Thanks, guys. And I think this is a follow-on question from the Cleanest Dirty Shirt. So it's aimed at you, and I'm going to read it verbatim as it's come through to me, because I think it's well written and asks the question nicely. So South Africa has been immune, in inverted commas, to risk before the war in Ukraine. I don't think anyone will say any country or market is ultimately immune to risk, particularly an emerging market fragility in some areas. So here's the question: if US markets really get hit really, really heavily, and a lot worse than right now, presumably the Rand and South African assets will come under heavy pressure, as we've seen previously in brackets. While South Africa has been relatively safe, surely South Africa has not become a safe haven. And I think the question is really in a scenario where it gets a lot worse and the US starts getting hit, our safe haven or relative safe haven status. Your thoughts on that?
Yeah, I think we're not a safe haven, absolutely not. As I said, we're definitely part of the dirty shirts, but it's just that we look a lot better today relative to all of the other options that emerging market investors have. You can't invest in Russia right now. You're reluctant to invest in China because of the regulatory crackdown on numerous industries. It's not just technology, it's healthcare, it's education. It'll probably be things like construction and property development, and all of these other industries are all going to be highly regulated. And so the chances of profits and value creation diminish substantially. And then you've got the issues in Brazil. So I think, you know, if you, and I think the other big plus obviously is that, you know, what Russia can't provide the world, South Africa can. And I do think that we do get, and I'm not going to use the word safe haven, but we certainly will be able to respond more rapidly than most other countries to supplying what America and Europe and the UK require, and certainly what China requires from Russia. So things like our platinum group metals, you know, it's coal. There are a lot of things that Russia provides that they will not be able to provide, at least in the short term. And so this opportunity, while it lasts, is a good thing. But yeah, we're definitely not a safe haven. And if this escalates into a broader European conflict, then there's no doubt we're going to travel in the same direction as all markets, which will be down.
Brian, if I might just give people some stats, just following on what Ian's saying about emerging markets, agreed, you know, we couldn't call South Africa a safe haven, but as an example, the MSCI Emerging Markets Index, and, you know, the BlackRock tracker of that index is close on $30 billion, so that's just a tracker fund. But if you look at the composition of the EM index, China is approximately 32%, and we know the woes in China where the government, with the stroke of a pen, can really hurt your business or make it obsolete. That's 30%. Then we look at Taiwan. You know, in the teens is number 2, and we know there are geopolitical risks there. I mean, I don't want to say, you know, China's going to invade Taiwan. I seriously hope not, because then we're really in for trouble. But the interesting part is South Africa, at the end of last year, was only 3.1%, and Russia was 3.5%. So what's happened now is, as of the end of February, Russia's 1.5%, so it halved, and my sense is it'll definitely halve again and again. South Africa's gone from 3.1 to 3.7. Brazil's about 5%, and they have their own woes. So what I'm trying to say is, if you look at the risks in China, maybe a bit in Taiwan, and we won't talk about number 3, South Korea, North Korea, there's a lot of risk there, and they're big weights. And there's not a lot of other places to go. South Africa is one of the fewer places to go, maybe Indonesia, Malaysia, but those are so small weights. So the weight of money that could be flowing out is large. And South Africa, I can tell you from looking at flows and stats and just reading EM commentators, you know, if you read some big EM fund managers commentary, they never talk about South Africa. You don't even hear about it, even though we might be 3%. So I think it's not a safe haven, but money has to flow somewhere. We're not flow traders. We look at valuation and quality. We're fundamental investors, and we do see it in South Africa. So relatively, we think we're not shaping up too badly.
Thanks, Ray. Guys, we've got time for one last question. We're moving to 10 o'clock very swiftly. And given that it's only another minute to go, you're allowed a one-word answer, but I need a word from each of you for this question. Sorry, just before I actually ask the question, there is a comment in the question pan saying, simply a very good punchy morning. So thank you to the Counterpoint team. We like those comments, guys. Thank you very much. So the question is, what do you think the China exposure in the JSE will be on an equivalent basis in 20 years' time? Paul, I think right now you said it was 33%. Was that the correct number? 33%. So yes. We're at 33% right now. What do you think the China exposure through the JSE, the look-through, will be in 20 years' time? You may not answer with more than one word. Ian, you first.
Less.
Less, okay, that's fine. Paul?
The same.
The same. Raymond?
I'm going to say a little bit less.
and just
20 years is too long. 20 years is way too long.
So just so that I'm not the one picking on you guys, I'm going to say 25%. Guys, that is the end of our session. We do thank you for attending. We really appreciate your support. If you'd like to ask us any other questions, please do so. And please remember to fill in the survey at the end. Our next contact point with Counterpoint will be a webinar on the 16th of March, where Pete Polyun will present his value strategy. We hope you have a lovely day, and thank you for listening in. Cheers, everybody.
Thank you.
Cheers,
Thank
everyone.
you. Thank you.